We now begin with our session. I would like to invite the moderator for today's session, Ms. Marin Agarwal, founder Finsafe India Private Limited. Marin has more than 24 years of experience in the wealth management industry and has worked with Citibank, Deutsche Bank, and Birla Sun Life. She has extensive experience in investment advisory, banking, debt, and stock markets. She was an independent investment advisor managing a multi-family office for exceptionally high net worth clients. Prior to starting Finsafe, which is a financial education organization in 2014, and is focused on equipping Indians with strategies to handle their money based on goals, growth, and safety. This company has already impacted over 60,000 people in the last 7 years of its journey. Marin is also co-founder of 𝗤𝗵𝗹𝗶𝗏, a financial awareness program for women, professionals, and otherwise. Marin has been widely recognized for her contribution to the financial services industry and has been a treasurer at 𝗥𝗷𝗲𝗏 Bangalore chapter and is a Shiro's member. Ms. Agarwal, the screen is yours.
Thank you, Gaurav. And good afternoon, everybody. Nice to be here today in this segment on challenging the conventional. And, as I look back on the last 1.5 years, right, what one really sees is that despite the pandemic, there's actually been a growth in all categories of investors, whether it is HNWI or the mass affluent or the retail investor. However, I think, the arrival of fintechs and the wealth techs and new customer segments like millennials or Gen Z millionaires, the traditional ecosystems and business models are really being challenged, and maybe the traditional RM-led model may really not be enough. Clients have also, of course, become more tech savvy and want a combination of digital and human interface. Added to that, a lot of other things that we're going to be talking about today. To help me in this conversation today, I have Nitin. Nitin is the MD and CEO of Avendus Wealth Management. He has over 2 decades of experience in private banking, asset management, and wealth management. His role and responsibility at Avendus include leading a team of high-performing private bankers, product specialists, portfolio managers, and strategic business functions to serve large UHNI clients, family offices, treasuries spread across India. Nitin joined Avendus from Standard Chartered Bank, where he was the managing director and head of the wealth management business that comprised 300+ team members. Welcome, Nitin. I'm also joined by Rajesh Saluja, and Rajesh joined ASK Group in December 2006 to set up the wealth advisory and multi-family office business. He comes with over 25 years of experience in wealth and capital management business. Prior to joining ASK Wealth Advisors, Mr. Saluja worked with Standard Chartered Bank as the business head, priority banking and deposits for the wealth management business in India. He's an honorary chartered wealth manager from the American Academy of Financial Management and holds a bachelor's degree in maths and economics, along with a master's in marketing management from University of Mumbai. Welcome, Rajesh. Nice to have you here as well. I also am joined by Neeraj Choksi. He is the founder and promoter of NJ Group of Companies since 1994, currently working in the capacity of joint managing director in the holding company. He's a graduate in business management from Sardar Patel University and a certified financial planner from FPSB, and a certified trust and estate planner from the American Association of Management. So thank you, everybody, for joining me today. And, my first question to Nitin would be on that, in the backdrop of everything that I spoke about in terms of, what we saw in the pandemic, the fact that we're seeing new products, new customer segments, new requirements, and most customers really want customized, sustainable investing solutions. So, my first question would be to you that, Nitin, what has been your experience in the last 1.5 years and how are you really seeing seeing what's happening in the wealth space?
He has a network issue, so you can route the questions to remaining two.
Okay, so Rajesh, if I could request you to take up that question.
Okay, Marin, can you just repeat that?
Yes. The question is that, in the last 1.5 years, so much has changed in our lives because of the pandemic. But one surprising thing that has also happened is that there is an emergence of new segment of investors, and, investors wanting much more. They want customized, sustainable solutions, new products in the market. So how are you really seeing this play out in the wealth space?
Right. So clearly, COVID has made a huge amount of new kind of investors that have come into the so-called investing world. I was just seeing the recent data of the number of Demat accounts opened, and from an average of around 4 million in a year, that number shot up to 1.4 million odd Demat accounts, new Demat accounts in the last 1.5 years. This has also been fueled by lots of online brokers, fintech firms, which are making investing accessible and very, very easy to a larger set of client segments. So you are seeing much larger interest in investing that has come about in the last 1.5 years. And I see that trend continuing. It's not something which is just come in because of the COVID disruption, but it's a much longer trend. New generation, the younger lot want to have access to means to execute, to get information, and to also participate in this long-term wealth creation opportunity that exists. Within the wealth trend, within the wealth management business per se, I think most firms are now focusing towards a more digitized platform to serve their clients. I think that's been a dramatic change. We've leapfrogged maybe 5 years and every wealth management firm has started to focus on how to serve their clients better, how to onboard clients digitally, because in that COVID period, it was very tough to even get documentation going or engage with clients. Secondly, how do you engage with clients virtually? And it's become a common norm now. Even clients earlier who were very reluctant to do Zoom calls and Teams calls today find it a very convenient way to engage with clients. Third, of course, is the entire backend processing, servicing, reporting, etc. Most wealth management firms have now started to look at how to digitize their entire platform to improve client experience, to improve productivity of relationship managers, and also to improve efficiency. So there's been a dramatic change at both ends. A new bunch of clients fueled by online platforms for investing, and wealth management businesses also transforming in a big way and having a large focus on creating a digital platform to serve their clients.
That's very interesting to see, because typically in the ultra HNI space, you would kind of, not think people would be, easy to adapt on a lot of these digital means, right? And, actually that gets me to a question to Neeraj, that Neeraj, of course, we've seen all of this Demat accounts being opened, this big interest from the retail market in investing in stocks. So I just wanted to understand that how are you leveraging data and analytics to actually keep up with market offerings? Because, every day we are seeing new products, we're seeing covered bonds, there was SPAC, there was NFT. Of course, all of these were not available in India, but covered bonds is very much there. And there are, so many other things that are coming about. So I just wanted to understand from you that how are you using data and analytics to actually keep up with the market offerings? I think, Neeraj, you're on mute.
Thanks, Marin. Am I audible now?
Yes, yes.
And of course, to the CFA Society for inviting me. Yeah, I think, see, we have a B2B platform where we are trying to have a hybrid kind of a model where there is a human interface for the advisory component. And as far as the technology is concerned. It is more for execution and giving them the reports and other aspects. Now, as a philosophy, we've always believed in asset allocation because its product comes at a later stage. But the most important thing is once the individual or a distributor understands the risk profile of the customer and he offers him a proper asset allocation, that this is the asset allocation which one should follow. And what essentially we have done is basically try to automate asset allocation, because it's a very fashionable word. It is not practiced, it is more preached. So how to make it practicable? For that, I think we have used the stock exchanges platform and other platforms where we can easily do the rebalancing of the assets on a regular interval at a fixed frequency. And once you go through that journey and you keep on explaining the clients that, yeah, this is something which is protecting you from any other things, because there will be a plethora of products which will be coming. There will be products which has a flavor of the day. But at the end of the day, on a sustainable basis, if you want to create wealth and get reasonable real returns, it is the asset allocation which is, I think, one of the most important things. And again, the asset allocation will depend from individual to individual, depending on their needs, the aspiration, the kind of wealth these individuals or HNIs or whosoever wants to create. So I think that is where a role of a distributor or an advisor comes, where the product is at a later stage, but it's more on asset allocation. And as far as data analytics is concerned, yes, data analytics generally is useful for upselling and cross-selling. So when you have multiple products, I think there are people who would be interesting. They may have different kind of needs. Insurance is again very, very important. We have seen during COVID that health insurance is so important and people were not covered adequately. And when you're not covered adequately, I think everything goes for a toss. So that technology obviously has evolved, and even in financial services, it has evolved. And we use data analytics to a certain extent because we mainly have a B2B platform where our customers are our distributors, and we try to help them in, servicing their clients, helping their clients to satisfy their needs.
All right. So would you also say that your marketing spends have gone up now, with all the evolving customer demands? Because while you talked about asset allocation, and I understand, of course, that's a very important, aspect of advice. But I think, from where I'm coming from, today we see customers very, very hungry for products. So, to that extent, are you seeing customers asking for new products? And, how are you really keeping up with all of these market offerings that are coming?
So as a philosophy, generally, we offer very simple products for long term. We don't offer what the customer wants, but generally what the customer needs. I think that is the philosophy which we have adopted since our inception, because we are very clear that, you will have a Zomato phobia or a Zomato mania, and such kind of things will keep on coming, and people would want to invest in those kind of products. And after that, the experience is so bad that many a times people leave away from the markets, and they curse the market. That market is like, it's very, very risky. But it's not, market is not risky. It is the behavior, the way in which you do, that is most important. And as a distribution community, we are trying to manage the behavior of our customers. When people are definitely excited about the cryptocurrencies of the world and other things, so at that point of time, we have to explain them that is something which is not required. And if at all you want to do, you will have to allocate a very, very small percentage of your assets toward it. You cannot put your serious money into such things. For growing your serious money, you have the SIPs of the world, and long-term equity is a proven asset class which has over long periods of time outperform the market. And generally, when you see, the for market gives a return, but the customer doesn't get their returns. I mean, there is a gap between the market returns, and there are so many empirical evidences for that. And this gap is basically because of behavior. And I continue to believe that as an intermediary, as a distributor, as an advisor, our role is to manage the behavior rather than offering them products.
That's great to see. And hopefully that's also a very big differentiator. Nitin, are you there? Can you hear me?
Yes, ma'am, I can. My apologies
No problem,
for the...
No problem. Good to have you here. So Nitin, we just started, and I was just talking about, the changing landscape and on the wealth space in India. And, one of the things that I wanted to ask you about was the new customer segments that have come in. So you have the millennial and the Gen Z millionaires, fueled by whatever ESOP money. You also have more women investing, and of course women investing is a topic very close to my heart. So I wanted to understand from you that how are some of these customer segments being addressed in your firm?
No, thank you for that, Marin. And yes, you're so right. And I was taking on from what Rajesh was talking about earlier. I think the last 18 months has led to a revolution. Not only in terms of how customers look at their portfolios and the kind of products that are offered, but also in terms of a number of these new emerging, TAMs in terms of target addressable markets for large wealth management firms. I think two pieces that are coming in. One is, of course, the influx of new money that is coming in through, as you said, these young 20-year-olds and 30-year-olds who are really creating some magic and therefore being able to create wealth also on the back of it. I think the second one that is also happening is that there is a very large professional segment now that is emerging as serious wealth customers, and I'm talking about ultra HNIs and UU HNIs. So the professional go-to-market where people are extremely are money rich but time poor, and are in a habit of being able to make decisions very quickly and really value professionalism is coming up. And I think the third one, which I completely agree with you, Marin, is the role of the woman, both entrepreneur as well as a decision maker, in terms of really being able to take sizable decisions around portfolios. I'm seeing that happen both across old families where, a large amount of third generation, fourth generation money, actually people managing that family office, actually most of the talent, is coming out of, women within the family, as well as women as a breed investing. So that's something that we've been focusing on in a very large way, because we believe that this is really what is going to fuel growth over the next few years, right? Both in terms of wealth management as well as in wealth creation. Digital technology, sustainability. I think are trends that are going to be there to stay on the wealth creation side. And I think as much as that, I think the role of a wealth manager to be able to provide those kind of emerging trends to customers, I think it's going to become more and more key. And this is the kind of segment that is actually very keen to look at it, right? So when we've been going and offering products, I've seen that the kind of questioning, the kind of decision making, the kind of analysis that these segments want is very different from the traditional customers, right? And which are much more still much more relationship oriented. I think a lot of this new money data is very important, right? Understanding what's happening in terms of why should they make a decision, and how portfolios are stacking up, how these products are looking, be it either private equity, be it fixed income, be it buying MLDs, be it anything, right? Data becomes very important. Decision making is much more quicker. Access and ease to technology and being able to view that in their own time and being available for this segment is much more important. So I think it's forcing wealth managers to change, right? And
so do you
I
have
agree with
like
Rajesh
a specific offering for, sorry to interrupt, but do you have like a specific offering for these particular segments, because they're very different from the traditional UHNIs, right?
Yes. And so you've stolen the words out of my mouth. So we are in the process of trying to launch a professional go-to-market and focus really on the UHNI segment, because that's something that I think we've all been struggling in terms of seeing how do we really look at that professional offering. And I think that's going to be based behind three things. One is in terms of digital and technology access of how we are able to provide them information. Second is in terms of RMs who resonate from, from interaction with these people. So we've been looking, interestingly, at a lot of hiring outside the traditional wealth management sector. So we've been hiring a lot of people from institutional equities, from corporate banking, from a lot of these industries where actually that resonation happens much more. But Marin, to cut a long story short, still work in progress, but something that I'm very excited about.
So Rajesh, I want to ask you this question, that while these new customer segments emerge and firms work towards having an offering to them, but, client behavior, if you see over, like I've seen it over the last 25 years, remains the same, that clients are always very demanding on returns, more so in bull markets, right? So, nowadays, I'm also hearing from my wealth RM friends about how you HNIs are coming to them saying, ki, aap mere ko stock trading nahi de rahe ho, and, my friend is doing stock trading and making so much of money. So how are you managing these client expectations and client behaviors?
See, every client is not your client, right? And as Neeraj rightly mentioned, a large part of our role is about managing client behavior. You have to have, some differentiation. If all the wealth management platforms offer the same thing, same product, same technology, then what differentiates one from the other? It's really your core investment philosophy through which you guide clients on what is the right way to behave. That comes in with a lot of experience of having seen various market cycles, over 25, 30, 35 years. You've seen the kind of mistakes people make, the kind of, wrong allocation calls they take. I mean, real estate used to be the sexiest asset class 15 years back, and people went overboard on allocation there and suffered. Then during euphoric bull markets, when the IT boom happened in the early years, 2000, 2003, everyone got carried into IT, and anything, the word technology used to give huge amount of get interest from clients. So there is this behavior of clients. Sometimes it's greed, sometimes it's less of alternative options that they have, sometimes it is aggressive risk taking. So our role as a wealth advisor is really to get the client focused towards the right direction, make sure that he can still achieve his goals with the least amount of risk, and manage his behavior during good and bad times. We always say investing has three key components: discipline, knowledge. Discipline is around discipline of asset allocation. Knowledge is about investing only in areas where you have some understanding of what you're doing. And third is temperament. Temperament is how you behave during good and bad times, and how you behave with the markets, how you behave with your investment. 90 to 95% of people lose money because of the temperament aspect.
Yeah.
Right? So our role is to control it. Yes, while product innovation is important, and there are very, very good investment ideas that have come up, and I think some of the local Indian firms have really driven that change, rather than just traditional mutual funds. There are good quality PMSs, there are good quality alternate investments which are there. There are real estate funds, private equity funds, all have a role to play, and there's some really good work happening there. But the idea is to then customize it, make it bespoke, and look at what the client need and fix it. So
sure.
Yeah.
So Nitin, staying on that same subject, how are you seeing like overseas, where there is this whole thing on ESG and sustainable investing? Are you seeing Indian clients asking for ESG?
Yes, Marin, sorry, firstly, can you hear me clearly?
Yeah.
Okay, perfect. Yeah, no, so I think there are two trends that I'm seeing in a large way. And one is that I'm seeing more and more, to answer your question on sustainability, one is that I'm seeing more and more sophisticated customers asking for answers around sustainability. And sustainability is just not about ESG, but it's about, I think sustainability is a larger word, about corporate governance, about the quality of the management, about, just so sustainability as a trend is, I think something that's emerging more and more and more. And I don't think we can say bye to it. And I'm seeing that come through, be it both on fixed income as well as on equity. A lot of the questions that key clients are asking are about that. I think the second trend that I'm seeing emerge, and I'm using the opportunity to talk about it, is really in terms of how is the entire digital and technology revolution that is happening in India today really shaping both client portfolios, right, as well as the kind of investment decisions that they are making. So clients are now very keen to understand, be it either on equity, be it on fixed income, be it in terms of funds that they're buying into, or be it in terms of general opportunities, as to how are these, how are new age businesses, new age processes, and how are really digital and technology trends being used to disrupt either existing businesses or new businesses. So these are two trends that I'm seeing a lot. Whenever I'm traveling anywhere, whenever I'm meeting customers are talking about how both impact on existing businesses and investments that they've made. How are these three trends, digital, technology, and sustainability, impacting that, as well as on new investments that they want to make. And I think that this is something we are seeing from a retail perspective, just from a Zomato, etc. But we're not realizing the kind of impact that this is going to have on traditional investing over the next few years. I think we've just touched the surface here.
Okay. That's very interesting to know and to see all of these new trends that are coming in. But one of the other things, Neeraj, is that transaction costs are falling. Certainly the fee pressures are there, especially, with the whole direct piece on mutual funds, people wanting to do international stocks, and a lot of offerings around international stocks at very low cost. So how are these really being, managed? And also, because world over, when I see, and also I was going through this Capgemini Wealth report, which talked about the fact that most, even in the UHNI space, people are really concerned about the fees that they pay in terms of transparency, value delivered, and as well as the fee level. So how do you think these fee pressures can be managed? Because certainly costs are going up, but fee looks to be going down.
Yes, I think in any industry, if you look at the margins are going down, and there are always some disruptors which are offering at zero cost also. But I continue to believe that what is not sustainable is not viable also. So at some point of time, every business model will have to come out, figure out with what is the kind of value you are adding. And again, I feel generally it is a myth that customers don't want to pay. There is only a few customer segment which is not wanting to pay, and they are making the most noise, and they become the representation of the mass. Generally, that is the kind of experience we have had over the last several years. So it is very, very important that what is the kind of value you are offering, and one has to have faith in yourself that yes, I am making a difference in your investment journey. If you are making a difference in the investment journey of a customer, then he should be able to pay. I mean, there was a report by IFIC Canada a few years back. It was like the difference between the returns of customers who went on their own, on the DIY customers, and the customers who were advised. I think over a period of 15 years, there was a compounded return of around 4.5% difference between the returns of these two. And that makes a huge difference in terms of the ultimate wealth which one creates. And it's not about the transaction cost one should look at. So if I am discussing with a customer, I think it's becoming penny wise and pound full when you talk about a transaction cost. It is important that what is the kind of offering, what is the kind of journey you are going to take through, because it's not a transactional business. It's a relationship business. One has to understand the psyche of an investor and take him through. It's not a one-shot transaction. If it has been a transaction business, yes, then one would have looked at the cost. But this is something very different, and that's where one will have to come and give the value addition which you are offering. But on an overall basis, I agree the costs are reducing, and you have to be efficient and manage your the business in such a way that it's win-win for all.
Yes, but the fact remains that we are also seeing a big segment of people, and here's where I want to come to the whole fintech, wealth tech conversation. Because I understand that at the end of the day, there has to be value, and customers need to see the value. Unfortunately, what I'm seeing right now is customers wanting everything free, and that's thanks to all of these deep-pocketed fintech firms that have come. So Rajesh, how do you see wealth tech or fintechs impacting the ultra HNI space? And how can firms like yours, can firms of yours look at offering some sort of hybrid models to these HNIs?
I think the digital journey has just begun for most wealth management firms, and there'll be three areas of focus. One, of course, the client experience. His reporting, his any information he wants about his portfolio, his statements. How do you ensure that he can do it on his own and take it as and when he wants? The second is relationship manager productivity. I think wealth tech will play a large role in ensuring that an RM can handle many more clients by trying to find ways to, for a large segment of clients, the servicing can be done using a very strong technology platform. So most wealth firms are trying to see if they can improve RM productivity. And third is about bringing your own cost down, because margins will be under pressure as in more competition comes in. So one is about adding value and trying to get yourself ahead with competition in front of a client. But more importantly would be, how can you eliminate and speed up back-end processes, thereby reducing cost to serve. So, and that also will help you scale up across segments. You need not be only in ultra HNI. You can come into HNI. You can go into tier 2, tier 3 cities using technology. So wealth tech will play three roles: advice, content, and execution. And I believe, there'll be about 4 or 5 major milestones in this journey. First, I think most wealth management firms will give their sales, marketing, and RMs an ability to conduct client acquisition, portfolio management, and advice through digital means. Broadly, what I mean is offering content. Second milestone, I think, will be when you integrate the transmission of all the customer information across multiple AMCs, channels, and products, which is a big piece missing even now. You have to depend on third-party people to always use statements.
Maybe the account aggregator would help to some extent.
Exactly, the aggregation. The third key milestone would be introducing technology in such a way to really input external data of a client, right? And then output specific client recommendations. So broadly, advice. How do you use technology to offer advice holistically across his portfolio? And I think fourth and fifth would be one, of course. Fourth, I would say easily, is transaction, where you allow the client to top up, to do further transactions straight through processing and avoid that whole RM service, RM interaction. This will help in increasing scale. And I think last but most important, which is where I see maximum impact of technology coming in, is going to be, or I would say disruption in some way, would be using artificial intelligence and big data analytics to provide insights, to both RMs for better decision-making on their clients or portfolio behavior. Because today, if you look at it, clients are overloaded with info. So if you use advanced analytics, one can understand each individual and can come up with better recommendation. So imagine a scenario where you can start taking signals from your client behavior and start to create new and automated suggestions. So my broad point is, I think RMs are not going away. You will need, technology will only support RMs to interact with clients better. Human capital actually applied in the right way with the right experience will continue to be a key differentiator, at least with the ultra HNI segment. Of course, it will make RMs more effective and get them to spend more time, more meaningful time with clients rather than just product discussions. Because remember, in the ultra HNI space, it's not only a portfolio management. There is wealth structuring, there is tax planning, there is creation of trust, there are global assets, domestic assets. So I believe the role of technology in wealth will be to bring clients up to a certain level of knowledge before then the client advisor takes over. And robo advisory, etc., will affect probably the mass affluent segment.
Mass affluent segment.
Exactly.
But Nitin, I just want to quickly ask you that, do you actually see the fintechs as a competition in the ultra HNI space?
No, I think Rajesh described the journey very well. In fact, I was thinking I should record it as an elevator pitch. So, but I do believe that that the fintechs, and very interestingly, you are now seeing some fintechs emerge in our immediate target competition pool. So for people like me and Rajesh, both in India and as well as in Singapore, I'm seeing the emergence of some fintechs who are trying to target really the UHNI wealth. But I think it's going to be more of a partnership model. I don't think that at this level immediately there's going to be a replacement of the trust that you place behind a trusted advisor, right? And but I think the pieces that Rajesh talked about, I think are going to happen, and you're really going to speed up. You're really going to see that increase in terms of speed. I think the other piece that I want to talk about a little bit, just taking on from Neeraj Bhai, was this whole concept of value add. I think what's going to become more and more critical as you see an increase in financialization and an increase in sophistication even for mass affluent as well as ultra HNI customers is the need for a wealth manager to be able to provide value add and be seen as somebody who's providing a value add. I think this whole piece about the fact that fintechs will come and completely disrupt the world hasn't happened, touch wood, so far globally as well. Even in the models that you see globally, at the end of it, be it Betterment, be it, I can name about 5 or 6 models. They've all finally evolved to an ecosystem where you haven't yet seen the Amazon's disruption the way that it's happened on retail consumer buying. And I think this whole concept of value add is going to become even more and more critical because the amount of data, amount of new products, the amount of just simple chaos, I get worried when my sister, who has absolutely no exposure to financial services and is a school teacher, calls me and says, should I buy cryptocurrency or should I buy the latest IPO that's coming out? And I think therefore the need for a wealth manager to be able to provide that value add, that is going to continue to remain critical. I think, of course, we as Indians don't like to pay fees, but I think
that's where the biggest challenge is, right? So just hold your thoughts there, Nitin, because I do have a segment on how can we improve image on financial advisors, because in the work that I do, where I see, and of course this is purely retail, of course it's not UHNI space, but I see this big pushback towards having financial advisors or taking formal financial advice. So just hold on to your thoughts because I have a couple of questions there. But Neeraj, I want to ask you that what do you make of this e-com culture coming into mutual funds, with one of the index funds becoming even more low cost than what index funds were or ETFs were? So what do you make of this e-com culture coming into mutual funds?
Basically, everything is going to move up. In India, if you look at the mutual fund penetration to GDP, it's still the lowest across even the Asian counterparts. So it is good, more and more people come and more indexes and other offerings are there. But at this point of time, I believe that the ETFs is more purchased by high net worth individual and institutions rather than retail investors. Because the retail investors will need some hand holding, they will need some distributor or advisor. Because this is not something that anyone is going to go and buy straight away. It is something that one will have to explain the significance and importance of that. And if there is nothing there for an advisor or a distributor into it, then that doesn't work. In US, still the RIA market is the largest market. They are the largest contributors and they charge decent fees to the customers. So ETFs are popular, but at the same time, the RIA's market has also grown. I think products can be commoditized, but advice cannot be commoditized. And in a commodity, the price pressure will be there. But if you believe in yourself, if you feel that, yes, I am providing value, then certainly the customers are ready to pay. It's just how you generate value, how you are able to differentiate and how you are able to demonstrate rather than differentiate. Because people don't understand simple returns. How to look at returns, they don't understand. They look at the returns which is there on the existing investment. They don't look at the entire journey of the return. So if you give them the performance of say I had invested 100,000 rupees before 10 years in a mutual fund, and then I sold it, and then and I made a profit on that, and now again it has gone down. People look at the recent returns that they feel that mera to 20%, 25% टूट गया hai if the market has fallen. But that's not the real story. If you start from the inception, you really made good returns. So it is how you project, how you, and that's where you have to use data meaningfully. You have to empower your distributors, your advisors, your RMs, so that they can meaningfully use this data and demonstrate that over long periods of time. And money is made in the waiting and not in anything else. And people are wanting to do. I mean, the generation which we are all talking about, the millennials, they want to do things overnight, everything, and that doesn't happen. If it happened once, then the fall is also similar. So the rules of physics and the rules of nature applies everywhere, but whatsoever it is, and it has a history of maybe 10,000 years of human life cycle. We have seen that several times happening, whether it was the tulip thing or whatever it was, but it has happened, and it bounces back. So as an advisor, the role has to be very, very simple, that you just, as Rajesh was saying, that you have to manage the temperament, you have to manage the composure. And sometimes it's not about knowledge, it's about the behavior. I think that makes a huge difference.
I agree. So I think, I completely agree. Of course, behavior makes a big difference. And of course, as you're saying, that there is basically a market for everyone. There's a market today for highly personalized advice, for mass affluent advice, and there's a market for DIY investor as well. And but I think, one thing that I'm seeing today is this whole, maybe it's a projection in the media, or maybe it's the fact that everywhere that you see, everybody is talking about this DIY investor who is making quick returns. And, we're talking about these 1 crore demat account, and most of these guys are stock trading or buying IPOs and doing IPO listing gains. And all of us don't believe in it, because we know that this is not the way to make wealth, right? So, but unfortunately, when I see over the last 1 year, all I see is these people, and all I hear about is this. And then to add to that, now we have social media influencers who are becoming very popular, and who also give a lot of misadvice, by the way. And either of you could take this, maybe, Nitin, you could take this if you want. But do you see, because when I talk to people, I do hear that, people, a lot of these influencers have like 10 lakh views and all on their videos. So do you actually see these influencers impacting HNI customers? Maybe retail customers, certainly, but do you actually see them impacting HNI customers?
I think it's a very interesting question. And no, I think to some extent, but not to a large extent. I haven't really, and maybe Rajesh may have a different view, but I think specifically talking about social media influencers and what's in the news and what's happening, I think, of course, the one typical thing with every HNI customer right now is that most discussions at the beginning always start with what's happening, and all these crazy trends that you're talking about. So this very quick summary that you gave, number of demat accounts, people buying like crazy, etc. That's like a common stroke through every HNI conversation. There is a FOMO effect. I'm not denying that there is a FOMO effect, even for HNI customers, and they want to have some sort of exposure to whatever's happening. But I don't think that has gone out of control yet, at least at that end. And I don't think this role of social media influencers here yet has played that piece. I'd be very keen to understand how you and Neeraj bhai, given that there's a lot of both retail and mass affluent access, how are you seeing that in that space? But from an UHNI perspective, I think lesser. I don't know if Rajesh has a different view.
Rajesh, I have a question for you on this, actually a related question, and then I'll answer your question, and I'll also give Neeraj time. Okay, don't mind. Rajesh, what I wanted to ask you was that I really don't see, I see a lot of independent advisors and a lot of smaller wealth firms, being there, writing articles, maybe contributing articles and stuff like that. Somehow I never see, any columns from, UHNI firms, right? I mean, of course, manufacturers, product manufacturers, and everybody is putting out articles there. Do you not think that, some of this may add some value? I know that the advice that you're giving is the biggest value, but do you think that being more in the media could be helpful in some way?
You see, our job is very boring. It's actually a very boring job, even when you talk.
Well, investing is boring, right? So,
exactly. So,
yeah.
And media never likes boring news, right?
I agree.
No, Rajesh, but there are a lot of advisors.
So, while we measure ourselves of, how much of media space we take, but at least from our organization perspective, it's always about, trying to link our organization with wisdom and knowledge. So it's more about knowledge sharing. And we do have articles where we come up with, our views on economy, markets, etc. But it's more knowledge sharing, where we want to associate ourselves as a knowledge-oriented firm or wisdom-oriented firm, rather than getting into, too many places where one wants to talk to us about whether the market going up or down is great, what is our view on market. We tend to avoid all that because none of us know it. And anyone who says that they know a lot about, quick trends is actually just playing to the media.
That absolutely.
I agree with Rajesh. We are not the flavor of the season for journalists to call us, because half the time we'll say we don't know.
To the galleries, basically.
Because half the time we'll say we don't know.
If you look at our role about asset allocation, customization, how much can you keep coming out of the media with it? Because it's such a personalized service. But if there is a trend on cryptocurrency, or if there's a trend on, then people like to hear, and then we are the wrong guys, because frankly, wealth managers tend to focus on advice. The second aspect, which is again related to social media that you mentioned, a lot of influencers, I think it's just a matter of time before it will also get regulated. Regulations, like how you've seen in developed markets, will also evolve here, right? Earlier in CNBC, you had 20 types of advisors who would give advice. Now that has also got regulated. So even in social media, there will be some genuine, good experienced people with good information to offer, and that will be great because it is a great platform to, influence others. But one will have to regulate that also, and so that, you're not just giving wrong advice, because advice is serious business. Investing is a serious business. It's not like coming up with a cooking show and having 1 lakh followers. This is about people's money. So I think both investor and frankly, with all this new generation getting into trading and 20 types of products coming in, it's very, very good for the wealth management industry, because this phase, if you could make 30-40% return every year, everyone would stop doing business and only get into this. So when people get caught in this trend, when that fall happens, people again realize the importance of financial planners and wealth advisors. So all these trends, what happened in 2000, 2003, 2006, 19, I can think of so many eras where mad euphoria, new bunch of people came in, wanted to do things on their own. If you had good knowledge and information, you did it well. But if you didn't, and you just went with what everyone was saying, you burnt your fingers, you either abused the markets, didn't go in for it, or then you went to professionals. So I feel all this is going to only help the industry. Regulations will also improve and ensure that people who are giving advice have the background to give advice and are not just, using their presence in the society to influence others. And all of this is only good for the industry, nothing else.
Yes. I think there's going to be more targeting now of regulation, because with the new accredited investor norms coming out, I think there's going to be a revolution within that space of how you look at products and product innovation and needs for the UHNI versus the mass affluent, because today SEBI had one mass sweep that they used to do, and I think hopefully that will tighten. And I think also secondly, pieces like crypto, etc., all of this that is coming out, if you see those ads, it can be quite scary, because it doesn't seem like you're buying a financial product. It seems like, I don't know what you're doing in that. But I think all of that is going to get regulated sooner rather than later. And I think coming back to Neeraj Bhai's point on value add, I think customers will more and more realizing the concept of value add. And I think even in terms of customers willing to either pay or to let you earn, as long as they're aware of what the fees is. So I think disclosure, accountability, and trust are 3 pieces that are becoming more and more key for customers as well.
That's good to know. And, I'm coming to my last question, and then we'll take questions from the audience. So, and my last question is to Neeraj, because, with all of this happening, certainly we need more advisors. And I think Nitin mentioned that you are hiring equity analysts, and you also need to look at reskilling current staff as well, right? So currently, my biggest issue with advisors is that there is no entry barrier to anybody being an advisor. And I don't find that great quality of advisors in the market, whether you look at banks, you look at just look across the space, the quality of advisors is not that great. Secondly, the image of an advisor. So, what I'm hearing, and, which I completely concur with all of you, that it is the value in the advice that is going to help the client. And all of these trends that we are seeing really never last. We have seen all of these happening in 2000, 2007. We've seen all of these happening, and we've seen how people have been scarred with it. Certainly, maybe the current lot also might be in for it. We only don't know when. But, in all this, one of the things that I have seen is that somehow the image, the quality and the image of advisors, Neeraj, has actually gone down. And certainly there is reskilling required even for the current lot. So, what do you think needs to be done to have better quality and improve the image of financial advice? Because I'll tell you, the issue today that I see is that the image of financial advice is not good.
So I don't know about quality, because if there is any data, please provide me that data, so it will be helpful to me. But as far as image is concerned, yes, that image is not so good. Basically, one will have to create that image. And as of now, if you look at the community of feet on street, that is also extremely less compared to the investing population. So I think there is a huge opportunity in terms of generating employment when new people can come. When I meet 12th standard students, no one wants to pursue a career in investment advisory. Everyone wants to become a chartered accountant or a company secretary. So at some point of time, I think at a regulator level, at the industry level, everyone has to create an image, because many a times I very, very clearly understand about the image. Because if you want to get your daughter married or your son married, and if someone says that he's an investment advisor, then that they will start shivering. Bhai, ye kya karta hoga? But if you say he's a chartered accountant, no problem. So that's the kind of a social image we have, and I believe that it has to be broken. And in terms of quality, I think that more training should happen, more investment should happen in terms of developing skills, and more data should be produced. Now this DIY thing is happening. Now you produce the data of DIY, the regulator should do that, the industry should do that, that people who are doing investments on their own, and what is being, how the investors are faring, who are with their distributors or with the advisors. I think those kind of data crunching has to be done, and then and only then we can probably judge about the quality. But I think in terms of training, a huge investment is required in skilling them in terms of behavioral planning, and that is one of the most critical. Probably sometime what happens in advice, the advisor is forgetting his role. He starts predicting trends. That is not the role of an advisor, that is the role of a research analyst or a fund manager. The role of the advisor is to manage the asset allocation, manage the composure, as Rajesh said, the dull and boring job which you have to do every now and then. And if you are able to do that every now and then and explain that, I think you have done your role. So that's I think very, very critical. But what sometimes people, just because of the news, because of the glamour which is all over and which is not there in advice, people tend to become glamorous. I think the advisors also trying to become glamorous, and that's where one has to ensure that you just stay focused to the kind of work which you are doing. But I think if you do that correctly, you are doing a huge value to your customers. And one thing which I wanted to say about the previous question, you said this trend is happening. Now I would just want to say that in investments, there is irrationality in behavior. And one has to accept that has happened over periods of time. We see irrational behavior. And if you want to bring rationality, few people will become rational even after telling them. Even after the advisor giving them good advice, they will not talk to him and they will do the execution elsewhere, because that fear, greed and hope is there and irrationality is there. And I don't know how to remove that irrationality. But over a period of time, with experience, with looking at couple of cycles, there are customers who understand that, and then they stay invested with good quality advisors.
Thank you, Neeraj, for that. So I'm just going to start the questions. I know we just have less than 10 minutes left. So essentially, Rajesh and Nitin, either of you could take this question. What are the tools, best practices that you use for identifying if a PMS or an AIF is good? And if you find it too specific, of course, you could say that. Another question that's being asked out here is that, are there any notable professional learning courses for wealth managers?
Okay, on PMS and AIF, I'm assuming the question is only around equities, because there are AIFs which are also equity.
Yeah.
But we look at, the performance not on a very short-term basis. We see it across market cycles. One is, the basic science around it, the drawdowns, how much of drawdown has happened in that PMS over a period of time, how the manager performed over longer periods of time versus the benchmark, etc. But more importantly, our biggest evaluation is always on the quality of stocks that the person has, the underlying portfolio, and the investment strategy behind that, and whether the person sticks to us. So for us, at least from ASK perspective, we always look at the quality of portfolio, quality of stocks. I'm specifically talking about PMS because it's not returns alone. We want to look at fund managers who have the ability to preserve capital first and then grow, rather than taking into account, just pure returns. So these are some of the aspects. When it comes to AIFs, which are non-equity kind, many other areas, fund managers, background, experience, track record, quality of investments he's made, exits earlier, all of those aspects come into play. It's a very detailed subject. I mean, we do 6 months of due diligence on any manager before we bring him on board, and there's a whole bunch of maybe if someone has specific interest in the meet and greet, maybe I'll be able to explain it.
I think just adding on to what Rajesh said, I think one of the important things for us, apart from all of this, is really in terms of the fund manager and how entrepreneurial, the quality of. So one of the pieces that we really focus on is about the skin on the skin in the game for the fund manager, right? And therefore the nature of the fund manager. And I think that becomes even more relevant when you're looking at AIFs and other instruments, either be it on terms of early stage, mid stage, or late stage investing on the unlisted side, because those are much longer in terms of gestation period and life cycles. And therefore, I think these are very, very critical pieces that we look at in addition to what, of course, Rajesh said. I think coming to the second question, apart from training courses, one of the issues that I've seen, and I think what Neeraj Bhai was talking about was very true. There is a dearth of quality talent within this space today. Starting right from the bottom and going all the way to the top. I think there is clearly a dearth of talent, and we've therefore all been trying to find innovative means of addressing that. There are no specific courses from, whilst there are a number of professional courses, be it starting with CFA and a few others, but I'm not aware of any specific courses from a private banking perspective. Rajesh, is there anything that you're aware of? I don't seem to remember something specific.
No, there are specific courses internationally, which you can into India, but otherwise you have your chart CWM, those kind of normal programs exist. Plus, institutions create their own sort of training program more than anything else.
Okay, all right. So, there's a question here on controlling client behavior, and I think we talked about that. There was another question on what advice you would give the founder of a wealth tech startup that's starting out in India today. And I think Neeraj covered it very well by saying products can be commoditized and advice cannot be, and focus on behavior planning. So I'll give the answer to that one. All right. Now, there's a question here saying that what is the scope for real estate market to boom? What would be the ideal plan for generating passive income? Investment in real estate, or real estate equities, or hybrid? And do you see how do you really see the whole real estate versus equities playing out? Anybody could take that.
So, real estate, since we run real estate funds, I can take that on. Real estate is an asset class which is of importance to most. I'm not talking about the real estate for consumption, but more from an investment standpoint. But I think over the last 7-8 years, there's been a change in mindset of clients who want to invest in real estate. The change is fundamentally about direct investment in real estate versus investment in real estate through concepts like real estate funds or REITs. Both REITs on the commercial side and real estate funds on the residential side. And there is a huge opportunity there, because as an asset class in India, the gap between the supply and demand is humongous. And also, I think with the reforms having come into place in real estate over the last 4 years, be it demonetization, be it RERA, be it GST, you have seen a lot of, not so serious players in the real estate business having gone aside. Also, developers who were mistreating this asset class, they themselves have gone belly up. So now you have serious real estate players. And you can see a lot of professionalism even coming in with large institutions investing in this asset class globally. So the market has improved in terms of quality of developers, more accountability for development and completing on time and executing on time. And B, there are very good financial structuring that you can do with real estate developers, especially for fund managers. So anyone looking at investing in real estate, our advice would be to look at some of these financial investments rather than directly buying real estate, which becomes a very, very big hassle to manage. And we've seen it. So unless you're consuming it, if it's purely from investment purpose, a recommendation would be to use the financial route rather than the real hard asset.
All right. So there's another last question that I'll take up, which is, what are the 3 most important advice that you want to give to budding wealth managers going ahead?
Anyone else? Neeraj? Yeah, please go ahead.
So I think first of all that you should act in the interest of the customer. I think that is the most critical thing. If that is in place, then all other things will fall in place. And the another 2 point is, don't forget that customer is the most important component. So act in the interest of customer. Don't have a short-term view. I think you cannot create history in a very short term. It has to be long term. Investment journey is also long term, and wealth creation business is long term. If we have seen several examples, Warren Buffett's 80% of his wealth was created in these last 10 years of his investing experience. So that's the power of compounding which this business provides. So you need to have patience. I think patience and conviction, if these 2 qualities are there, and don't follow what the world is doing, follow what is right for the customer. If you continue to do that, I am sure success will be there.
Thank you, Neeraj. And I would just like to sum up. Thank you, all of you, Rajesh, Neeraj, and Nitin, so much for your views. Just summing up, I'd like to just, in terms of a takeaway, I think, what really came across was that there is space for everybody, and it's really up to you, to follow what you believe in. Certainly, human capital is going to be always favored. There might be a lot of digitization, but it's always going to be, human capital is always going to be important. And some of the good takeaways, I think, from Neeraj, of course, was that advice cannot be commoditized and behavior planning is important. Rajesh talked about how technology is going to help in scaling up and speeding up and ensure that RMs have more meaningful conversations with their customers and do not spend time on operational matters. And Nitin also, of course, talked a lot about data analytics and also about how ESG digital technology, all of these are themes that continue to play an important role for customers, or are playing an important role for you HNI customers going forward. So thank you, everybody. Thank you so much for being here today.
Thank you very much.
Thank you.
Thank you. Bye-bye.
Thank you.
Bye.
Yeah.
Great.